Nowadays, in trading and in trading community, you can find lots of the different approaches, method and the concepts how to analyze and trade the market. ICT, smart money concept, supply and demand, liquidity trading, price action. Everything sounds very complex and professional. But if you will dive a little bit deeper into those concepts, you will be able to see that this is the same classical technical analysis where you are dealing just with the price charts, with some rebranded words as the liquidity, institutional trading, imbalances, etc. But you need to understand something. If you are using just price charts, it's very difficult to find where was liquidity taking, where it was imbalance, and when institutional clients opening their position, and it's becoming just a guessing. Today I want to talk with you about imbalance, because concept of imbalance, this pattern presents almost in all those approaches. I will show you the classical approach, I will explain you why it's not working 100%, and then I will show you one indicator. So we create one indicator, we added there some real market data, and right now it's not just a logical but also profitable. So stay until the end of this video and let's start. So first of all, we need to understand what does it mean, this imbalance, and what's the classical logic and interpretation behind of it. So imbalance is happening in the market when the price moving too fast and it's not giving enough time for buyers and sellers to trade with the fair price. So that's why it's creating some kind of fair value gaps. What's the main idea behind the it? Why it's happening? That in some moments institutional clients start entering the market. As they cannot enter the market just with one order, they start splitting their orders, That's why price creating this kind of fast movement in one direction, leaving behind of it fair value gaps. Price after that supposed to return back to this fair value gap to take more liquidity and fulfill their orders. This is the main point where, based on their interpretation, you should open a position in direction of the movement that happened before. Let's check how it's look like on the chart. Before moving to the chart, I want to show you just based on the drawing how it's look like and what does it mean, this fair value gaps in the real trading. So first of all, we need to refresh in our mind that every candle in our chart, when it's created, it has four prices: open when the price was open, close when the price was closed, highest. This is the highest price during the time frame of creation of the candle, low, this is the lowest price. So this imbalance, this is the price pattern that include three candles. The first of all, what is the most important point? It's creating some kind of directional move, and the second point, the high of the first candle, if we are going for the bullish imbalance, supposed to be lower than the low of the third candle. So that's why it's creating for us this kind of fair value gaps. This is one more time very important to understand. We are comparing first candle and the third candle, and what is the main logic? That the price after this kind of directional movement like up supposed to go back to this fair value gap, and then we are opening position in this particular example buy. Let's check the same for the bearish example, yes? So we have three candles, and here it's very important that the low of the first candle supposed to be higher than the high of the third candle. Also, we can see here some kind of creation of this fair value gap. Again, the main logic that the price supposed to go back for the 50% of this fair value gap, and here we'll be able to open position sell, where we are putting our stop loss in the take profit based on the general logic. So the main take profit, like a stop loss, supposed to be under or above creation of our fair value gap. In our example is here, but the take profit I still didn't understand, and this is one of the questions what I have to the main idea of the fair value gap. We are putting based on the liquidity, where it's liquidity, it's very hard to find on the real chart, but let's go to check what is going on the real charts. let's go direct to the charts because I want to show you how those imbalances look like in the real trading. So right now in front of you, I open gold, time frame M15 and provider paper stone. It's very important and I will explain you a bit later why. So I want to show you two beautiful examples of imbalances. First of all, it's the bullish one, and we can see that the high of the first candle is like lower than the low of the third candle. I will remind you one more time that don't forget that we are comparing between each other like first and the third candle, and this is the same example, but for the bearish one we can see that the low of the first candle is higher than the high of the third candle. So what's the main logic? I will explain you one more time of trading those kind of patterns, that after creating of imbalances we are waiting for the price correction to the 50% of the fair value gap, opening position here and putting stop loss under this level. And if we're also talking about like a bearish imbalances, also we're waiting correction for the 50% of fair value gap, opening that position in the same direction where imbalance happened and putting stop loss like above it, you know. And let's check what happened in our two examples. Here price successfully reached to our 50% of fair value gap, we opened buy, and depends on the level of your take profit, or you close it in plus or you was closed successfully by the stop loss somewhere here. With the sell also we had the correction to the 50%, we opened sell and price a little bit but went into the direction of imbalance, and after that start moving in totally opposite direction. So this is the classical approach, and I have three major problems with it. Problem number one, you know, for me, if we're talking about idea behind of the imbalances, that this is the trading of institutional clients, becoming just a guessing, because how come without proper internal data I can understand that these three candles pattern, this is the real institutional trade. Number two, you know, not everything clear with the take profits, because in most YouTubers and the sources what I was reading like before preparing for this kind of video, I saw that they are putting like put on the closest liquidity maximum of minimum, and I didn't guess how to understand where is the liquidity based on the candles. And the third major problem, the most important, like for example, if we can see this kind of bullish imbalance on the paper stone, let's go to check, for example, to change from paper stone to the IC markets, and ta-da! We don't have this kind of imbalance here. So what happened? There was no institutional clients, or maybe just this is the major problem of the classical, like, you know, candle analysis. This is my problems, but let me show you what kind of logic we added to these classical patterns and why it's working right now. What is my personal opinion and what I'm trying to explain? That searching imbalances in the market is really smart and logical idea, but what ICT and smart money calling imbalances is just based on the visual price structure, based on the three candle pattern, and it's not related to the real volume imbalances. So if we want to find where is this imbalances, we can use even the same pattern, but we need to add there some volume data, because without using the volume, you know, it's becoming just like hypothesis, but with volume it's become real market fact. And this is why we create Impulse Volume Trend indicator. So let me show you it. First of all, when you will open this indicator, I think you will be able to see how beautifully it's working and giving us nice entry points during the trend type of the movement. Look how many profitable signals we was able to get there. But what is my personal position and opinion how you can enter position? Of course, you can do this in more classical way. So after this imbalance, you will wait for the correction and then open your position in direction of the imbalance. But let me show you just this like 5 examples. 1, 2, 3, 4, 5. All of them was like really profitable, but just in one example, you see it's went down and took this to the 50% of the fair value gap. So my opinion in this particular indicator, and what I saw, it's better to open position immediately after you will be able to see this kind of imbalance. Second point, take profit you should put under the imbalance, after the lowest point of the imbalance, and take profit, my recommendation to put, it depends on your risk and profit appetite, but you need to put 1 to 1 or 1 to 2, depends on the trading instrument. Like a third point, I can show you also another example that maybe in some choppy markets it wasn't working in the proper way. So we were thinking how to implement that in the better way, and that's why we call it trend, because we just not calculating imbalances, we are comparing sell imbalances between the buy, and when the price covering, for example, the previous imbalance on the sell, buy imbalance covering sell imbalance, we will draw that here is like a new trend in the market. So my recommendation, don't just trade following the trend, this is number one, and you should start opening like a new position not in the beginning of the trend, but only after creating of it. Look, the same it's happened here. So we have two imbalances here we are not opening, we are still waiting, and only in this imbalance, immediately after opening position, after this imbalance, we can start trading. And by the way, this is the same example when we had 1, 2, 3, 4 profitable signals to open position, and none of them went back to the 50% of the fair value gap. So this is, guys, this is just my quick explanation how you can use this indicator. So it's counted volume and it's counting trend type of the conditions of the market. So why not? It's already nice, and I think it's deserve you to try this indicator. I will just wait your feedback in the comment section. Thank you very much for watching this video, and hope that with these instruments you will be able to make a lot of money in the forex trading. Thank you very much for watching, and see you in our next video.